Hi, Tom here, and today we're going to talk about when you should switch your LLC to be taxed as an S corporation. If you have an LLC, you may have heard that there are tax savings to be had by making an S corporation election. You may have also heard that it doesn't make sense to do this until you make a certain amount of money from your business. But how does this all work? And when does it make sense? And when doesn't it make sense to make this S Corp election? And what is this certain amount of money that you need to make in order to make it worthwhile? And are there any downsides to this? That's what we will explore in this video. First, we need to understand what an LLC is. It is a limited liability company, and it is a state law entity that gives you liability protection similar to a corporation without all the formalities and paperwork and costs associated with having an actual corporation. Now, it is a state law concept, not a tax one. So you go to your state's Secretary of State office, you file the paperwork, you pay the appropriate fee, and then you form your limited liability company. But there is no such thing as an LLC tax return. So if you ask a tax advisor, how is my LLC taxed? Well, it is not a straightforward question because it depends. What the IRS is going to do is they are going to tax your LLC as if it were one of the IRS recognized type of entities. So for a single member LLC, in other words, if there's just one owner, we sometimes call that an SM LLC, the default is that that is taxed as a sole proprietorship, which means you put the profit and loss from the business on Schedule C of your Form 1040. So there's no separate tax return you have to do. You just add this Schedule C to your regular tax return. If you have a multi-member LLC, then the default is for that to be taxed as a partnership. So that's if you have two, three, four, or more owners. And for a partnership, there is a separate tax return called a Form 1065, partnership income tax return. But for this video, we're going to focus on the single member LLC because that's usually where this question comes up about whether or not to make the S Corp election, even though the same principles would apply for a partnership. So if you have a single member LLC and you don't do anything else, you just go, you get your LLC, you start doing business, comes to the end of the tax year, it's time to file your taxes, you are automatically considered a sole proprietorship and you file Schedule C with your 1040. But any LLC can make an election with the IRS to be taxed as an S corporation as long as they qualify. And if you have a single member LLC, then most likely you qualify to be taxed as an S corporation. Actually, any LLC can actually make an election to be taxed as a C corporation. But most don't do that. Most of them who are making some kind of election are electing to be taxed as an S corporation. So that's what we're going to talk about. You make that S Corp election by filing Form 2553 with the IRS. And you have to do this early in the tax year. So, for example, if you want the S Corp election to be effective for the tax year of 2025, you have to file it by March 15th of 2025. You don't get to wait until the end of the year and see how much money you make and then decide whether or not you want to be an S corporation. Now, the good news is this is a one and done filing. So you file the Form 2553 once, and then you are an S corporation from then on. You don't have to file it every year. You can actually revoke the election in the future if you want to, but absent that, you're just going to be an S corporation from then on. So let's talk about now the S Corp trick because that's what this all leads to. And they call it the S Corp trick. That's just a marketing gimmick, but you'll see this in online advertisements and things where they'll say, hey, you can save all this money through this S Corp trick. It's not really a trick, it's just the way the tax law works. But here's what we're talking about. What they will say is instead of being taxed as a sole proprietorship, instead make that election to be taxed as an S corporation. And if you do that, you can save 15.3% tax on a part of your profits. And then obviously this can save you thousands of dollars per year. But it only makes sense once your earnings reach a certain income level, a level that I call the tipping point. And to understand this whole thing, we need to know what the self-employment tax is, because when they say that you can save 15.3% of tax on your earnings, what they are talking about is the self-employment tax. So if you have a regular job, a W-2 job, a salary, you've probably noticed that withheld from your salary, in addition to income tax, is Social Security, or sometimes called FICA, and Medicare. And the total that they withhold is 7.65% of your salary. 6.2% of that is for Social Security, 1.45% of that is for Medicare. In addition, your employer has to match that 7.65% from their own funds. So you put in 7.65% of your salary, your employer matches that 7.65% of your salary. So the IRS then gets 15.3% of your salary to cover Social Security and Medicare. Now, it is important to note that the Social Security piece of that is maxed out at a salary of $176,100 for 2025. So for your first $176,100, they're going to take out 7.65% of your salary for Social Security and Medicare. And then once you get over that amount, they're going to stop taking out the 6.2% for Social Security, and they're only going to take out the 1.45% for Medicare. And that is per person per year, the $176,100. So if you've got more than one job and they total more than $176,100, you're only going to owe the Social Security piece on your first $176,100. Also, that number is the 2025 number. It goes up every year. So if you're looking at this in 2026 or later, you'll want to go to irs.gov and see what is the current number, the current income cap for the Social Security withholding. If you are self-employed, then you don't have a job or an employer to withhold and pay any of this Social Security or Medicare tax for you. Therefore, you must pay a self-employment tax of 15.3%. And it's 15.3% because you are considered to be both the employee and the employer. So you're going to pay the 7.65% employee portion and the 7.65% employer portion. And again, it is maxed out at earnings of $176,100 for 2025. Self-employment tax is only due on earned income. It does not apply to investment income or passive type of income like interest, dividends, and capital gains. So, for example, if you buy stock in the stock market and you receive dividends, that's your portion of the profits of the company, there's no self-employment tax on that. You will pay income tax, but not Social Security or Medicare because you didn't work for that money. The reason you got that money, those profits, is because you took a risk and you invested in that corporation. And so your return on your investment for taking that risk is the dividends. And so you pay income tax, but not self-employment tax or Social Security and Medicare. So for example, if you own Walmart stock, you might get a dividend and then you get that, you pay your income tax on it, but not self-employment tax. But let's say you also happen to work for Walmart. So you've got a job with Walmart, you're getting a salary. So of course they are going to withhold 7.65% of your salary, and then Walmart is going to match that 7.65%. But now you're also getting dividends. Well, you still don't have to pay any Social Security or Medicare tax on the dividends because that is not the portion that you got for working. Yes, you work for Walmart, but the salary that you got, you paid your 7.65%. But the dividends that you're getting is not because you worked there. The dividends you're getting is because you took a risk and you invested in the stock. And so you are getting this dividend income. So you don't have to pay Social Security or Medicare tax on that piece of it. So this leads us to the steps to how we go from sole proprietorship to S Corp and why we do it. So what you do is you form your LLC. That defaults, as we said, to being taxed as a sole proprietorship. Once your income exceeds this tipping point that we're talking about, you elect S Corp status. Now, you can do that at any time, as we said before. You don't have to do it right away. You can wait. So you wait until your income is high enough in order to make this worthwhile. And then once you do that, you take part of the profits from the business as salary and part of it as dividends. And so you save 15.3% on the dividends portion. So it's like working for Walmart. You got your salary for working for your company. So you do pay the 15.3% on that. But The dividend portion, that's not subject to Social Security and Medicare tax, so you don't pay the 15.3% on that. And the tipping point then is when this savings of self-employment tax outweighs the risks, the cost, and the hassles of being an S corporation. So let's look at an example so we can actually put dollars to this so you can see how it works. So our example here is an LLC with a net profit of $100,000, and the owner takes the whole $100,000 of cash from the business for the year. So we're going to look at this in two different ways. First, as if it were a sole proprietorship, and secondly, as if it were an S Corp. So if it's a sole proprietorship, the owner is going to pay income tax on the $100,000, of course, and they're going to pay self-employment tax of $15,300. That's the $100,000 profit times 15.3% self-employment tax. If instead the business was an S corporation or taxed as an S corporation, now let's say the owner takes a salary of $40,000 and they take a dividend of $60,000. So it's the same $100,000 that they're taking out of the business. It's just now split between salary and dividends. Well, the owner is still going to pay income tax on the whole $100,000. That doesn't change. But now they're going to pay Social Security and Medicare tax of only $6,120. That's 15.3% of the $40,000 salary. So what happens is the owner, as an employee, is going to get the $40,000 salary and is going to have withheld from his paycheck 7.65%. But then the company has to match that 7.65%. And of course, in this example, the owner, in effect, is the company. So the owner is paying both 7.65% for a total of 15.3%. But that $6,120 is $9,180 less than he would pay if he were being taxed as a sole proprietorship. So the savings for making this S Corp election is $9,180. That's the $15,300 that he would pay if he were a sole proprietorship, minus the $6,120 he would pay if he were an S corporation. So a very reasonable question to ask at this point is, why would you not do this? Why would you not take this money? Well, there are some reasons why you would not do it. And the first is that you may not have enough profits in order to make it worthwhile. So if your reasonable salary is, as in our example, $40,000, and the profits from the business are $40,000 or less, then it doesn't make any sense. You've gone through all the trouble of becoming an S corporation and you got no tax savings whatsoever. The other reason is that you may have already maxed out your Social Security withholding for the year. So maybe you have a W-2 job where you already make $176,100 or more, and this LLC is just a side business. Or maybe you have another business where you've already maxed out your $176,100 for the year for Social Security. And so, again, it may not make sense for this new business to be taxed as an S corporation because you still would save some money. You would save the 2.9% Medicare piece. But once you've reached that 176,100, you're no longer saving the 6.2% Social Security piece, which when you double that, that's 12.4% of the 15.3% is from Social Security. You're not saving that anymore. So it may not now make sense to make this S Corp election because of all of the other hassles and costs that are involved with being an S Corp that we will talk about soon. And that leads us to the third reason why you might not do that, and that is that the savings that you get on self-employment tax may just not be enough to cover the extra costs and the risk and the hassle. So let's say your business makes $50,000 and your reasonable salary is $40,000. So you could save 15.3% on $10,000, which would be $1,530. But by the time you subtract the other costs and the hassles of dealing with this, it may not make sense for you to do it. So when I talk about the risks and the hassles and the added costs, what do I mean? Well, when we talk about risk, the primary risk is an audit risk. Now, I keep saying that you have to pay yourself a reasonable salary, and this is where the IRS is likely to audit you and have a problem. They will have to agree with you that the salary that you have chosen is reasonable, and they may not agree. They can argue that your salary should have been higher. they could maybe even argue that the whole profit of your business should be counted as your salary. And if that happens, and if they prevail in that, then you are going to owe all of the tax that you should have paid in. Plus, you are going to owe substantial penalties and interest for not paying that money in when you should have paid it in. And of course, that can lead to not only having to pay the tax and the penalties and the interest, it could also lead to having to pay legal fees and accounting fees. Ultimately, some of these cases actually go to court. There's a lot of court cases where the IRS and the taxpayer can't agree. And so they go to court and they let a judge decide. Well, now you've reached a whole new level of legal fees. Plus, it's just a big distraction. And you're supposed to be running your business, not having to worry about IRS audits and court cases. So there are people out there, there are business owners out there who have this bright idea of how they're going to save a bunch of money. And so what they say is, well, I will just take all of my profits as a dividend and I will give myself zero salary. Therefore, I will save 15.3% on all this money. Well, they're just playing Russian roulette with the IRS, and eventually they are going to lose because the IRS have their computers looking for this. So their computers are programmed to look for, we have an S corporation and you don't have any salary coming out, and they're just going to automatically flag it to the auditors. So they are going to come looking for you. So that is not a bright idea. But even if you don't do that, so a lot of business owners know that they can't give themselves zero salary, but maybe they give themselves a very low salary. And so again, you are just risking this audit and then all of what goes with that audit. So that is the primary risk that we are talking about. Now we get into the extra costs and the extra hassles. Once you make an S Corp election, you now have to file a separate tax return. In addition to your 1040, you now have to file an S Corp return, a Form 1120S. And this is more complicated than a regular 1040. So you're going to have to pay a tax advisor to do it for you, and you're going to have to pay that. Now, how much you're going to have to pay, well, that's going to depend on where you live and your particular tax advisor, but you're probably going to have to pay at least $500. It could even be $750, $1,000, or even more, depending on where you live and how complicated your Form 1120S is for your business. And not only are you going to have to pay the costs, but now it's just kind of an extra hassle. It's an extra tax return you have to file. It's another due date that you have to worry about. And so it just adds to the hassle factor and the distraction factor. And another thing is sometimes people think, well, I'll just switch back and forth every year. If it looks like I'm going to have a good year, then I'll be an S Corp. And if it looks like I'm not going to have such a great year, I'll go back to being a sole proprietorship. But you can't do that. Or I guess you can do it once. So remember, I said once you make an S Corp election, it is good unless and until you revoke it. And you can do that. So you could elect it one year and then revoke it the next year. However, once you revoke it, you cannot elect S Corp status again for 5 more years. So you can't just go back and forth. So you need to kind of pick a lane. You need to decide, is it time for me to be an S Corp? And if it is, then you make that S Corp election, and then you just stay an S Corp from then on. If it's not time, then just wait. Keep being a sole proprietor, and wait until it makes sense to make that S Corp election. Then, in addition to these other costs and hassles and considerations, there are going to be other payroll taxes. Once you decide to be an S Corp, pay yourself a salary, not only are you going to have Social Security and Medicare, you're going to have other payroll taxes, in particular unemployment tax. So you're going to have federal unemployment tax and state unemployment tax. And depending on where you live, you could have other types of payroll taxes that apply in your state or in your municipality. So you want to consider all of those when you are making this decision. And then finally, you're going to have to now run payroll. If you did not previously have employees where you were already running payroll, you are now going to have to set up payroll. You're probably going to hire a payroll company and or a bookkeeper in order to run this payroll for you. And that is going to cost something. And it is kind of an extra hassle as well. So you're going to have to factor that in as well. So this tipping point that we're talking about means that you have to decide at what point do the self-employment tax savings outweigh these risks, hassles, and extra costs. And when I gave you all those risks, hassles, and extra costs, it may have sounded like I'm trying to talk you out of making this S Corp election, and that's not the case. What I'm trying to do is give you balance because there's so many people out there trying to sell you on this, and they only want to tell you the good parts and they don't want to tell you the down parts. So I just want to make sure that you know the downsides as well as the good parts so that you can make a good balanced decision. And whether or not it makes sense for you does vary depending on the circumstances. And the circumstances include what is a reasonable salary for your job compared to the profits of the company and how much time and effort you put into the business. What other sources or types of income do you have? What type of business is it? Is it a business where most of your money comes from you providing services, or is it a business where your money comes from capital or assets, such as selling things or producing things with machinery that you have? That can make a difference on what happens, what a reasonable salary is, and how this all plays out. And then, of course, there are those added extra costs and hassles of being an S Corp that we just talked about. So, what you will want to do is check with a tax advisor, but ultimately, it is your decision. You, as the business owner, have to be the one that makes this decision. So, how do you make that decision? What's the process? So, here are the steps you want to go through. First and foremost, and most important, this is the crux of the whole thing, is you need to determine what is a reasonable salary for what you do. So what you want to try to figure out is if you were doing a comparable job, you were doing the same tasks that you now do working for yourself, but you were doing those as an employee for someone else, how much salary would you get paid? And when you think about this, you need to add in the administrative functions. So if you are, for example, a graphic designer and you work for somebody else, you might just show up in the morning, do your graphic designing all day, and then go home at night. But if you're working for yourself, you've got other tasks that you have to do. You're going to have to do sales and marketing, and you're going to have to keep track of your income and your expenses. You might be evaluating different software programs. There are all kinds of administrative functions you could have. So you need to factor that in because you should probably get paid more than someone who's just receiving a salary for doing just the graphic design. And of course, you want to look at this in your geographic region in order to get an idea. How do you do this? Well, get creative. Maybe you go out to internet job sites and you see similar jobs that are posted and what their salary ranges are. Maybe you talk to friends that you know that are in this business as employees. And if you're good enough friends, then maybe they're willing to share with you how much money that they make. Now, they may not show you the W-2, but they might tell you how much you can make. And then you can write that down and keep track of it and keep notes on that of who told you what and how much they made. Maybe you just got a job offer. You applied for a job doing what you do in your business. You decided to turn it down to start your own business, but still that can give you an idea and a data point for how much money you might make for doing the business. Again, keeping in mind a little bit extra for the administrative functions. So whatever you do, however you gather this data, you want to keep documentation. If you go out to those internet job sites, you want to keep copies of those job postings as you saw with the salary ranges. If you talk to friends, you want to make notes, you want to keep notes. If you get your own job offer, you want to keep a copy of that. And then just write a little note, some notes to yourself, to your file, explaining all of this and how you came up with your reasonable salary. So that way, if you get audited, you can show the IRS auditor, say, hey, look, I didn't just pull this number out of thin air. I actually I did some research, and here's what I looked at, and here's how I came up with my number. That will go a long way to getting you a favorable outcome on a reasonable salary. It doesn't guarantee it, of course. I can never guess what the IRS might do in any particular situation, but it will definitely help. And then as you go forward, if you are working for somewhere else, most likely you are going to get a salary raise every year for cost of living. So you would want to take that into account as well. Once you have determined your reasonable salary, then you need to estimate the profit for your business, not considering the salary. So in other words, if you stay a sole proprietorship, how much profit do you think you are going to make? If you've been in business for 2, 3, or more years, you probably got a pretty realistic idea of how much money you think you are going to make, say, next year. If you are just starting this business, then I have found that many new business owners who are starting up are let's say, overly optimistic with how much money they think they are going to make. So you want to take that into account. So if you're just starting, you haven't actually done this business as a business before, then you might want to kind of dial back how much money you think you are going to make. Because if you overestimate it, you might end up making this S Corp election and not making as much money as you thought and end up with zero tax savings. And in the meanwhile, now you have to pay to have an S Corp tax return done and all the payroll taxes and having payroll done and all the hassles that are involved. So it's just not worth it. So be a little conservative. Worst case, you get to the end of your first year, you made more money than you thought you made, and you say, darn it, I should have made that S Corp election. But you know what? That's just 1 year. It's 15.3% of the portion that would have been a dividend. Yes, that's not great, but it's not the end of the world. Plus, you just had a good year, so you're probably feeling pretty good anyway. And now you can just make that S Corp election for next year, and then you will have it going forward. But once you've estimated your profit, then what you want to do is calculate your tax savings. And the savings is 15.3% of the dividends piece. So the dividends is your total profit minus your salary. So in the example we did, the total profit was $100,000. The salary is $40,000. So the dividend piece was $60,000. So the savings is that $60,000 times 15.3%. And of course, you want to remember that $176,100 income cap on the Social Security piece. Once you have determined that, then you need to subtract the added costs of being an S Corp. So the other payroll taxes like unemployment that we talked about, maybe you can talk to a bookkeeper in your area or a payroll service company in your area to estimate what those fees would be. Your tax or accounting fees for filing your Form 1120-S. Talk to your tax advisor. How much is it likely to cost you to have that tax return done? And then if you're not already running payroll, what are the costs to run payroll? You can again talk to a payroll service company or a bookkeeper, and they can give you an idea of what it's going to cost you in a year to run payroll. Once you subtract that from your estimated tax savings, you have your net savings, and then you need to decide whether or not that amount of savings is worth the extra hassle and risk. And there's no right or wrong answer here. Let's say you do all these calculations and you find out that you would save $1,000. Well, you could have two different business owners. One of them could be like, oh, $1,000, absolutely, I'm doing that all day long. And another owner could be like, it's only $1,000. I'm risking getting audited. I have to file this extra return. It's not worth it. I'm going to wait until I make more money, and then I'll think about making an S Corp election. Well, that's fine. Neither of them is right or is wrong. It just depends on the individual business owner's temperament and opinion. So now, I know a lot of you have watched this video and you're thinking, Tom, this is all great, but just tell me, when should I make an S Corp election, or at least when should I consider it? So I am going to go ahead and give you a rule of thumb that you can follow. Once your net profits from your business are $25,000 more than your reasonable salary. So you need to go through that exercise of determining your reasonable salary and the exercise of estimating your profits. Once those profits that you estimate are $25,000 or more than the reasonable salary, then you should consider an S Corp election. It's not automatic. I'm not saying you should definitely do it at that point. But what I am saying is you should at least consider it. So you will want to meet with your tax advisor and discuss this. And then with your tax advisor, you can go through these detailed steps that we just talked about, and then you can make your decision. So let's give you an example. Let's say that you have done your research and you've determined that a reasonable salary for what you do is $50,000 per year, and that your business profit coming up is likely to be $75,000 for the year. So the dividend portion, the difference between those, is $25,000. So that's the tax that you're going to save is on $25,000. So you take that $25,000 times 15.3%, and you will save $3,825 of self-employment tax by making this S Corp election. But from that, we need to subtract the other costs. So let's say your accountant fees to do your S Corp tax return are $750 per year. I've just chosen a number. Yours could be less or it could be more, particularly if you have a very complicated business structure. You could end up paying more than that. But let's just say, for purposes of this example, that return will cost you $750. Then you've got payroll taxes to consider. And again, I'm just estimating here, but let's say that your extra payroll taxes that you would have to pay are $1,000, and that is going to cost you $500 a year to have a payroll service run your payroll. So we're going to subtract all those costs from our tax savings, and you end up with saving, by becoming an S corporation, $1,575 per year. And then you have to decide, is saving $1,575 per year worth the extra risks and the hassles of making the S Corp election? So what questions do you have? Go ahead and leave those general type questions in the comments. I'll be glad to answer them. Of course, I cannot give you legal or tax advice for your specific situation over YouTube. For that, you need to talk to your tax advisor, but happy to answer those general types of questions. And I thank you for watching, and I'll see you on the next one.